Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Well, hello, everybody. Welcome to episode 1685. I got to tell you, things are getting bad out there. Bad stuff. But I'm saying bad from the perspective of it being bad for most and really great for others. But I think even though it's good for me, my own self-interest, right? This economy is great for me, but I'm not happy. Why am I not happy? Because I think we are just massively increasing the wealth gap. COVID, it has made the rich 54% richer in a year. 54% richer. And mostly, well, not completely, the poor are getting poorer. Certainly in other countries that is happening. In the US, it's kind of mixed because these enhanced unemployment benefits have been so high that people are making more money sitting at home on the couch than they would going to work. I mean, talk to any small business right now, and they will tell you that our stupid government's plan has simply made it impossible to hire people. They don't want to come to work. I mean, why come to work when you can sit at home and just do nothing and earn more money? If someone is in the lower rung of wages, it's a better deal to stay home. So these incentives have just got to end. They have just got to end. We'll see what happens. But here's what I mean about the wealth gap and why I think things are getting ugly out there. Comes down to one word, a word I talk about very, very often. What is that word? Well, you know what that word is. Yes, you know what that word is. It is inflation. And inflation is becoming severe. It is becoming very, very significant. Let's talk about that. And let's talk about a little bit about what's causing it today. Part 2 of this episode will be a mortgage update where Adam interviews one of our lenders and talks about what's going on in the mortgage market. And, look, folks, this is why the rich are getting richer and, mixed on the poor end. Some of the poor are actually getting richer too, but mostly it's just bad, right? Because what they don't see is that, all of these benefits, all of these unemployment benefits, enhanced unemployment, all of these government bailouts, obviously, right away, it seems great because, hey, they got extra money. The check is bigger. But then the inflation comes behind it. Oh, I don't know what to compare it to. Maybe I'd compare it to my youth when I lived in the ocean, in the Pacific Ocean. I basically lived there in the water. And I used to boogie board all the time, did a little bit of surfing, but surfing is hard work. Let me tell you, surfing is a lot tougher than boogie boarding. But, I would do mostly boogie boarding, right? Before there's a big set of waves, it's usually pretty calm. And the water draws out a bit. Certainly this is true before a tsunami. And the water draws out a bit. And then this big set of waves comes, right? And that's what you're just loving because the big set of waves is a lot of fun. And, that's what's happening with inflation. I mean, we had sort of the water draw out, meaning the deflation of the currency. As you print more currency, every currency unit in existence already has to decline in value because two things, right? Two drivers for the value of anything, as I've talked about many times, scarcity and utility. So these are, of course, Zimbabwe dollars. One of my podcast listeners sent these to me years ago. One of these is 50 trillion Zimbabwe dollars, and here's a 100 trillion Zimbabwe dollars, and they're basically worthless, right? Scarcity and utility. That's what creates value. So when you make more currency units, you have a limited amount of goods and services, you're just going to get inflation. Let's talk about that because it is very severe. So I talk about inflation-induced debt destruction. This is a term that I trademarked years and years ago. And what it does is it basically tells you how to play the game, how to align your interests with the most powerful forces the human race has ever known, governments and central banks. Governments and central banks being the most powerful forces the human race has ever known. So what do? Right? Well, we use commodity investing, packaged commodity investing, along with debt, long-term fixed rate debt. And that is what I call the double inflation arbitrage. And inflation is looking severe, like very significant. And it will impoverish most people, and it will make the few people, the small number of people who get it, it will make them much, much richer. And that's the group I want you to be in. So that's what I try and help people do as I've been teaching about this for the last 18 years. So take a look at this chart. Consumer spending drives U.S. GDP growth in Q1 2021. Everybody is spending money. Now look at this is the opposite of the doom and gloomers, right? All the doom and gloomers predicted the end of the world last year. And what they didn't realize is that, of course, our rich uncle Jerome Powell, chairman of the Federal Reserve, would step in and crank up the printing press. And he would just create more currency units out of thin air, more dollars out of thin air. And that would have a hugely stimulative effect on the economy, as it always does. But it can't last forever. Nothing lasts forever. Eventually, someone has got to take the punch bowl away, and the party ends. And it ends with a big, ugly hangover, and that hangover is called inflation. And that's exactly where we're going. So things in some ways, I kind of hesitated there because it's very uneven. In some ways, look really good. And in some ways, they are just profoundly dangerous. Warning signals that what we are doing cannot possibly work in the long run. We cannot kick the can down the road forever. So housing starts are rising despite the cost to buyers. And these costs, we've talked all about lumber prices. And here it says, although housing starts are rising, lumber prices have skyrocketed in the past 12 months, causing the average price of a new single-family home to increase by $35,872, according to the National Association of Home Builders, the NAHB. Now, that's lumber, and everybody's heard about that by now. But I'll bet you the next time this report comes out, okay, it's monthly, we will see that this has even become more pronounced, more extreme. And those lumber prices, maybe the next time we hear this report, we'll hear that the NAHB is saying that the average new home has now increased by $46,000 or $42,000 or whatever it is. And I talked to one of our clients, Bruce, who's in the lumber business, in a multi-generational family lumber business here in Florida, selling lumber to home builders. And he's got the inside track. If anybody's got the inside track, he does. And he has really just explained that it's not because of supply-demand shock due to COVID shutdowns. That has resolved. This is real demand, and this demand is causing significant home price inflation, and that looks like it's going to continue. Now, I teach a strategy called packaged commodities investing, which means you look at, when's the last time you had cake? Did anybody celebrate a birthday recently? Did you have some cake? Well, the cake is made up of ingredients. Well, guess what? So is the house. So is the home. And it's made up of ingredients. And what are the ingredients? Of course, they are steel, lumber, petroleum products, copper wire, and copper prices are going through the roof. Copper is a really important commodity. It's used as a measuring stick by all the experts in commodities, the commodities brokers. In fact, they respect copper prices so much as an indicator of what is going on. They actually gave it a nickname. You know what they call it? They call it Dr. Copper. Not to be confused with Dr. Pepper. It's Dr. Copper. Okay. Dr. Copper is a big indicator. And it's not just lumber, folks. There are shortages in all sorts of things in the supply chain, copper being one of them. But packaged commodities investing. So you've got lumber, concrete, petroleum products, glass, steel, labor. Labor shortages are affecting home builders. And there is a shortage of housing, no question about it. Here's what's going on with copper. It topped $10,000 a metric ton for the first time in 10 years. In 10 years. And look at the chart. The chart just shows basically a parabolic increase in copper prices. And so that is happening. There are all these signs of inflation all around us. If we are not paying attention to this, then we have only ourselves to blame. We have only ourselves to blame. So we've got to pay attention to this inflation. Here's another article. Framing lumber hits $1,200 per 1,000 board feet. That piece of plywood, it's about 300% more expensive than it was just last year. Absolutely staggering what's going on here and how this affects everything. As of the week ending April 23rd, the price of framing lumber was up $1,250 per 1,000 board feet. That's up an unbelievable 250%. See, it's up more than that now, when lumber prices were roughly just $350 per 1,000 board feet. This housing affordability problem is not going to get better anytime soon. And you just intuitively know that no matter what the government tells us, no matter what the Federal Reserve tells us, or the other central banks or the other governments around the world tell us, you just know intuitively the truth, don't you? Yes, you do. You know the truth. And what is the truth? The inflation rate in pretty much everything is so much higher than we are being led to believe. Have you been to the grocery store lately? Have you been to a restaurant lately? These prices are through the roof. I just can't believe it. I mean, when I go to the grocery store, I think, how is it that like a normal family on a normal income gets by? It's just crazy. These prices are insane. And the inflation is not only reflected in the price, right? It's also something called shrinkflation. So if you look at products, make sure you pay attention to this when you go to the grocery store. It's just one example. You're getting less for the same price or more. So the package may be the same size, but if you look at the net weight, there's less stuff in the package, fewer potato chips, fewer whatever. Shrinkflation is occurring all around us. And another thing is service. By the way, I didn't even talk about the gas lines and the gas prices and all of this stuff. So if you want to learn more about inflation-induced debt destruction, get this free mini book that we have. It's totally free, no strings attached. There's no credit card, no nothing. It's just free. Okay, free. Yes. Go to pandemicinvesting.com and just get this mini book. It talks about inflation-induced debt destruction, as well as a whole bunch of my other good techniques to just win in this environment we're in. Okay, so we've got shrinkflation. We've got inflation, where the price just goes up, and many of us see that. It's very apparent. But wait, there's more. It's not just that. What about the service level? Let's go back to restaurants. For a while, I wasn't eating out very much. You probably weren't either. And now I've been going to some restaurants lately. And the service is awful. Now, it's awful mostly because the restaurants can't get people to come back to work because they're making too much money with enhanced unemployment benefits sitting at home. So the government has incentivized people to sit at home. That's bad. That's malinvestment. That's just not a good thing. It's not moral. It's not good for anybody. But it gets worse. That action by the government of incentivizing people not to work is actually very inflationary. Think that through. Think how that works. Okay? So the restaurants, the retailers, all of these businesses, in order to entice people to come to work, they have to make it worth it for them. Naturally, the people think, well, why should I work when I can sit at home and make more money on enhanced unemployment benefits, right? Or I'll figure out how to milk some other government program. Maybe I'm suddenly disabled. I've never seen so many young people who should not be disabled getting disability benefits from the government. Have you? That's been going on for like a decade or more now. Like millions of people, young, able-bodied people that are getting disability benefits from the government. So everybody figures out a way to game the system and scam the government, right? And so now the employers all have to pay more to get people to come to work. So what do they have to do? Well, they have to raise their prices, or they have to just go out of business or cut services. Restaurants. Over the weekend, I was in Cape Coral, Florida, looking at properties. And I just can't believe how understaffed these restaurants are. And the hotels, same thing with the hotels. In fact, I was staying at the Westin Hotel in Sarasota, beautiful property. And I talked to the manager, and she told me if we could get 20 more people on our staff today, we would hire them instantly. People just don't respond. They don't respond to the job postings, the other employees that they have in their Rolodex, figuratively, they won't come into work. It's just not worth it for them. So the employers will have to pay people more, or they'll have to just offer less. The bottom line to all of this whole conversation is this. For most people, given what is going on right now, the standard of living in America, and certainly even it's worse in other countries, in many other countries, much worse than the US. The reason is complicated, but the US has the reserve currency of the world, and they can basically print the money with less consequence than other countries can. So the US is pretty lucky in that way. But even in the US, the standard of living is declining, and it is declining more quickly than it has maybe at any other time in probably anybody's lifetime, anybody who's watching or listening to this now. And that is going to have hugely significant effects. What can you do? What can you do to protect yourself? Well, get my free pandemic investing mini book. Okay, just get that. It's totally free. Read it. Listen to all of my podcast episodes, watch all the YouTube videos on my YouTube channel or the other channels, some of the more controversial videos that can't go on YouTube because they will delete them, are on other platforms. Watch them, learn about it, learn what you can do, use inflation-induced debt destruction. I was looking at a house that I was emailed today. I cannot believe these housing prices. They're absolutely insane. Now, that doesn't mean housing affordability is that bad, because it's not. And if you have followed my Hartman comparison index, the HCI, or seen any of my recent presentations, maybe on the YouTube channel, about my comparison of real estate prices and mortgage payments to many other assets, it's actually not that expensive. But if you only were investing in dollars, holding dollars, it does look expensive, right? I got an email of a house today, Sarasota, Florida. I couldn't believe it. $2.9 million in change. And then I looked at the square footage, 2,900 square feet. $1,000 a square foot in Sarasota, Florida? Are you kidding me? These housing prices are just becoming crazy, crazy, crazy. Now, I know that if some of you are watching or listening and you're not familiar with my work, you may think I'm kind of jumping around and contradicting myself. I'm not. You just have to peel back the layers of the onion to really understand it. So please check out prior podcast episodes, YouTube videos, etc., to learn more. Read the book, Pandemic Investing, free book. You'll get it, okay? Or contact one of our investment counselors. We'll be glad to help you. All right. So that's it. There's our info, jasonhartman.com. If you're in the US, 1-800-HARTMAN. You can just pick up the phone and call us, and we're glad to help you. Thank you so much. Happy investing, and let's go to our mortgage update.
Welcome to this episode of the Mortgage Minutes here on the Creating Wealth podcast and the Jason Hartman Network. We are joined today by one of our favorite lenders. How are you today?
Good, sir. How are you, Adam? Thank you for having me.
Absolutely. It's great to have you. I wanted to have you on because we haven't talked mortgages in a while, and there's been a whole lot of change since the last time we talked. But I want to start first with the whole notion of rates increasing. And one thing that I kind of laugh at is people talk about how rates are higher now. But realistically, I look at where rates are today, and we'll get into the exact numbers in a second. But they're really what I was paying. They're really on the low end of what I was paying for properties, back 1 to 2 years ago. Where are rates, historically speaking, as from your time in the mortgage industry?
Oh, gosh. Well, I've been in the business for nearly 20 years, but as it relates to turnkey financing and investment property financing, we started to concentrate on that about 7 or 8 years ago. So if you're looking at that timeline, historically speaking, within that time frame, the current market rates are still quite good as it relates to, your typical investment property, single-family home with 20 or 25% down. Certainly at levels, they're certainly close to pre-COVID rate levels, I would say, maybe a little bit better, like you said. So historically, still very good, but from what we've been used to for the last 18 months, 12 to 18 months, certainly they've popped off what I call those COVID lows. The pandemic obviously is a global issue, a global phenomenon, has put market rates at a very low level historically, in fact, all-time lows. So we were spoiled a little bit in terms of being able to produce or sell interest rates at levels that were unheard of or unseen before. So it does become a little bit of a rate shock to folks when they see, especially the last 2 or 3 months with some of the changes that have occurred in the industry and with Fannie and Freddie, to see rates pop up back to more of a historical level. But again, still quite good.
Yeah.
But, to give you some answers or maybe my thoughts on the reasons why we've come off those lows. Well, a lot of the stimulus packages that were passed, and even the infrastructure bill that's being floated now, they're all, really Treasury bonds that are financing that, or they're issuing Treasury bonds to do so. There isn't a tremendous amount of demand for Treasury bonds, with the stock market continuing to hit all-time highs across all levels of the market. The Dow, the S&P, the NASDAQ, all of them kind of reaching new highs at any other week here. So we're not seeing an awful lot of demand or, demand for bonds, which, mortgage-backed securities or Treasury bonds. So we've seen rates kind of pop a little bit off of just a natural reaction to the market. But also Fannie and Freddie have instituted or brought out some new guidance as it relates to investment properties and second homes. And they've basically mandated that every lender who produces these loans to them cap their production at 7%. So some of those smaller lenders, smaller volume lenders, will certainly put loan level price adjustments on or artificially add to their interest rates to slow down that production. Some will, put credit overlays or credit guidelines on top of Fannie and Freddie's guidelines, to slow down that production. An example of that might be they will only do 25% down, or an example of that might be they will not allow a borrower to do up to 10 finance properties like the big banks do, So things like that are happening as it relates to more recent times and what Fannie and Freddie have come out with as their new guidance. I think some of that is a knee-jerk reaction in relation to the volume that was produced in 2020 with rates as low as they were. You don't typically see your investment property portfolio refinance at the rate that it did. Like, for example, we were refinancing some of our turnkey investor clients that have 5, 6, 7, maybe 8 or 9 properties and refinancing them all at the same time. So that's unusual in a normal market for that to occur. I also think that you had, folks that had cabin fever and folks that would normally take a family vacation, for example, and go to Europe or go to Africa or go, somewhere with their families and spend some money there, had cabin fever and they couldn't travel, and they looked at the second home market as a way to kind of break out a little bit. So there was a lot of demand for second homes, and that was a spike over normal volume that you would normally see. So the guidance from Fannie was we're going to cap the production of second homes and investment properties to 7% of a lender's total production. And I think it's relatively temporary. I think it's a 52-week guidance to see how lenders react to it and see in a year from now whether that will be reversed or renewed. So I think what we're seeing is rates are higher as a result of some of that.
Yeah, so with that, if it is a 52-week guidance and it does go away in, I guess at this point it'd be something like 44 weeks or 40 weeks or whatever.
Yeah, maybe March or April of next year.
Yeah, what would you expect the impact to be if they did do away with it?
Well, I would say, in addition to that, though, at the end of the year, Fannie also put on an artificial price add-on to investment properties for refinances. They added a 0.5 point as a loan level price adjustment for any refinance. So I think if the production levels are curbed or slowed, that I think by next year you might see rates come back down a little bit further, particularly if we haven't emerged fully from the recession, right, the COVID-related recession. I mean, certainly the economy is doing better. Certainly the vaccines are going to help. The vaccination level is going to help in terms of getting industries back to normal. And these stimulus packages are going to create jobs. However, it may not be for some time before we realize that. So I think if these guidances are reversed or at least slow, they've curbed the production. With the current rate environment that we're in, we're going to revert back to a normal level of production for both second homes and investment properties. So I think what we'll see is some of these artificial price add-ons to rate will disappear.
Okay.
And then you'll be truly in maybe a little bit better of a rate environment. But again, that's always going to be subject to how the market's reacting and how we evolve out of recession too. So I think that there's some economic thought out there that the stock market will continue to rise. I don't think there's really an end in sight to that at the moment, but I guess you never know. As we come out of the COVID-related recession, I think they're probably right a little bit. I think it'll probably continue to go, but it should stabilize.
Yeah. So let's talk about rates then. I mean, a lot of times in the past we've talked about, rates for homes in the $100,000 price range, but as I'm sure you've seen as the volumes come in, those homes don't really exist much anymore. So we're going to talk today about more of the $200,000 house. What are we seeing rate-wise for a $200,000 property? Yeah,
and I think that as it relates to price, I think that's something to do with inventory as well. Obviously, there's a shortage of inventory, so you're seeing price increases because of that, and you're also seeing more new construction in the market. But yeah, a $200,000 purchase price with 20% down. Today we're going to be at like 4.75 with no points. But if you paid like a little over 2 points, like 2.1 in points, you'd get down to maybe 3.875. Sometimes you'll get to 3.625, depending on FICO and depending on loan size. But generally speaking, between 3.6 and 3.875, you're going to see, with 2 points and 20% down, you can get down to that rate level. Now, compare that to 25% down, and we're going to be at like 4 1/8 to 4 1/4 for 25% down. So when I look at that, I see better value for money for a client who's putting 20% down and paying 2 points, like 2 points being 2% of the loan amount. So on a $150,000 mortgage, you pay an extra $3,000 in fees or in points to buy the rate down to 3.875. That's better value for me than putting the extra 5% down on a $200,000 price, because that's an extra $10,000 that only gets you down to 4.125 or 4 1/4. So by putting less money down, you actually can get a better interest rate. The points then are also tax deductible for our clients. So they haven't changed that tax code yet, so hopefully that stays in place. But the points are also tax deductible. So what that means is, let's say your income tax bracket is 30%, you can get 30%, let's say, of the points that you paid when you purchased the home back as an income tax break. Okay, so just reduces your income tax burden a little bit deeper. So I think that's good value for money, and overall you're going to buy a rate down to a level that probably won't be touched again, or it'll be very difficult to get rates back down to that level again without another pandemic or something major happening globally.
And without paying another loan origination, another appraisal, and all that other fun stuff. We haven't talked about this in a while. What is when you're looking at, kind of what you recommend to your clients and borrowers, when you're looking at pain points and getting your mortgage payment down, what kind of break-even timeline do you generally look for whenever you're talking about buying points?
I'm looking for a break-even. Like if you spend that $3,000 in points to buy the rate down, when you compare that to the rate with no points,
right?
So you got to look at what the payment is at, let's say 4.75 versus 3.75, let's say, or 3.625. See what the savings are on a monthly basis. It could be $100, it could be $110 a month or something. If you can break even on the cost of those points, I would say generally at the 3-year break-even mark, maybe a little bit higher, certainly no more than 4 years break-even. That's good value for me because it's a long-term hold. It's a 30-year fixed rate. You're buying the rate down to a level that we anticipate not maybe touching again, and not refinancing just through COVID for the sake of refinancing to a lower rate. Not necessarily taking cash out or anything else, but just to refinance the existing debt on your investment property. I think if you can break even on the cost of those points in 3 years, give or take, then you've got 27 years of those savings, right? So, let's say you save $100 a month on your payment. You'll save $100 a month. Yeah, you save up like $32,500 over the life of the loan in interest, and you'll spend $3,000 up front to do it. So that's a pretty good ROI on that $3,000 over the life of the loan. Now, of course, are you going to hold on to it for 30 years? Who knows? But at least if you hold on to it for 15 or 20, you're still going to come out way ahead.
Yeah.
So I look at the break-even, Adam, of 3 to 4 years as on an investment property. If this was your primary residency where you were refinancing, on the overall cost, not just points, but on the overall cost, you want to be breaking even in about 12 months.
Great. One of the things that I've been curious about is in this environment where we're seeing so much appreciation all over the country, and especially in the markets that our clients are buying properties in,
yes.
Are you seeing people going even lower and and I don't even know if y'all have programs at the moment that do this, and doing like a 15% down, pay the PMI for a couple of, 6 months, and then do another appraisal and see if the appreciation has pulled you up to the 20% mark?
Well, the 15% down option has a couple of layers to it, right? First of all, you cannot have more than 6 financed homes. It's a Freddie Mac product that allows you to do 15% down. So if you've got less than 6 financed homes, it is an option. On these price points, that PMI with a good credit score really isn't a lot every month. So some folks will try and do that. You have to have PMI in place for a period of time before they will just drop it when you show them that your appraised value is higher. But technically, yes, you can do 15% down, take the PMI for the short term, ask the servicer then to do an appraisal on the property, let's say 6 or 9 or 12 months from the day you bought it. If the property has appreciated to the point where you're at 78% loan to value, you can then request the servicer to drop that monthly PMI. Maybe it's $30, $40 a month or something. And that's just it's not a refinance. There's no cost to it other than the cost of the appraisal. And then those servicers typically will say, well, you were supposed to have your PMI for X amount of years, but, a lot of our clients will say, well, I have the value now. I can always simply refinance away from you and pay the refinance costs and get rid of my PMI. So when that happens, the servicer would generally say, okay, we don't want this to churn. We don't want this loan to be originated 9, 12 months ago and then disappear, right? Because there's no money in it for them. So they'll typically just play ball and drop the mortgage insurance monthly amount because you are technically at 78% or better loan to value. But that's really a conversation or a transaction that you do with the servicer of your loan once your loan's established and once you've asked them to do a new appraisal.
And so let's talk about kind of the mortgage starts and kind of the level of business that you're seeing. You talked about how when, the COVID lows were there, it was really, you're getting bombarded, just getting swamped with people wanting to refinance and buy with the rates where they are. Now that we're, a couple months into slightly higher rates, but, we're still seeing an inventory shortage everywhere. People are still buying homes like crazy. Have the mortgage starts in your office tailed off at all, or are y'all still at the same levels? Or kind of give us a hint of what's going on in the market mortgage start-wise.
Best way for me to kind of show that, it would be just our loan volume or closing volume, right, or our application volume. So let's say November, December, January, when rates were super low and we were taking a lot of refi applications and all of our purchase applications, we were probably taking in about 150 to 160 apps a month and closing anywhere between 100 and 120 loans per month. So our app-to-close ratio is very good. We're still closing at about 100 loans a month. Some of that is just legacy pipeline, but our application volume has not diminished all that much. We're still seeing application volume come in at a clip of about 100 to 110 loans per month. So for us, that's good. I mean, it's probably a testament to our team and our execution, also a testament to our rates and stuff. But also, I think there's a large enough company volume-wise where they're not impacted as much as, let's say, some of the smaller lenders and competitors that we go up against in terms of how those guys have adapted to curbing the production to stay below that 7% cap rule from Fannie and Freddie. So I think we're seeing some volume come through or some application volume come through from clients that we may have worked with in the past, but they may have tried out with another lender, and now that lender has got loan level price adjustments or guidelines that are not as favorable, let's say, as ours now. So we kind of win a little bit in the sense that our company's overall volume to Fannie and Freddie is quite big, but also just our independent individual team here. I think it's a testament to their execution and their knowledge of the industry, and also our ability to keep rates relatively low by showing the value of paying points to a degree.
All right, fantastic. Is there anything I haven't asked you that you think is important for people to know today?
Yeah, I mean, I just think that, appraisals are a concern sometimes with inventory levels as low as they are, because some people, or sometimes prices, you'll overbid on a home sometimes as a competitive nature to get the property, and then that appraisal may be overlist or slightly overpriced, or maybe an aggressively purchased home, and that appraiser may or may not come in at the value. So I would say just kind of be prepared to bridge the gap if you're in a competitive environment and you're paying a little bit more from a house than let's say the guy that you're in competition with. Because that appraiser might not have the comp that is in the market 6 months from now. Maybe it's a new construction or something. That comp will materialize, but it hasn't quite materialized, even though you're at a price point where you're going to pay a little bit more than what you normally would for the competitive nature of the environment that we're in.
Yeah, you're going to become the comp.
Well, you might make the comp, yeah, but at the same time, cash buyers as well are not really a comp for us, because every lender needs a lender to be the comp. It needs to be a financed home. Cash buyers are a good indicator of a comp, but doesn't necessarily mean we can hang too much weight on that comp because it's not a financed home, right? And, obviously lenders will do a little bit more due diligence sometimes than a cash buyer.
All right. Well, thank you so much for your time today. I appreciate it, and thanks for all the insight.
Of course, yeah, we're here. If anybody wants to just reach out, give us a call. You probably know who we are. Just let us know if you need any assistance at all. Thanks.
All right. Have a great day.
Great. Bye, Adam.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.